Okay, so it's game over for these financial markets, or is it? Okay, so hello and welcome to our latest urgent market update video for Wednesday, the 7th of August, 2024. And the whole idea behind this particular short video is to, I suppose, assess where we are now in current market conditions. So you may have experienced a significant amount of selling over a 3-day period from last Thursday to this Monday, the 5th of August. There was considerable discussions as to whether the Fed would have an urgent meeting to basically cut rates straight away, that it was panic time. And we saw some of the most significant market moves since Black Friday in 1987. So really, really bearish dynamic, but we want to delve a little bit into whether it is justifiable or not. The problem when you have a bubble type buy everything market dynamic, which we've seen over the last 12 to 18 months, is that you experience very significant irrational buying on the way up, and you also can experience very significant irrational selling on the way down. And for us, that's pretty much what's happened. We've had a few days of exceptional irrational selling. So we do have a few conclusions to draw, and we will leave you with what our bias is in the coming days ahead. So let's get straight into this short video then. Please see a risk warning currently up on screen. And as always, just be mindful of the risks involved in trading these financial markets. Okay, so let's get straight into this discussion then. Firstly, I want to just share with you the considerable volatility that we have seen in these markets over the last 5 days. So I just want to draw your attention to this bit of price action here. In fact, we'll include yesterday and today as well. And I'll do that across some of the world's largest markets, just 5 days of trading. And you can see that the direction of, well, the euro dollar is also applicable. It's just in the opposite direction. The euro dollar, the dollar yen is in a slightly different dynamic, but look at the rollover we've seen in gold and also in crude oil. Let's just swap this out. Let's have a look at the dollar CAD. So these are obviously some of the most significant markets out there, from the S&P, the NASDAQ, crude oil, gold, the euro dollar, of course, and the dollar CAD. And what we want to draw your attention to is obviously the very significant selling that we've experienced, massive moves lower in all of these markets. We have an upside down view really of the euro dollar, so it's the same dynamic. It's just we had a massive rally to the upside. So if we take that into consideration, and we'll have a look at some of the data, the news events shortly, to just explain there is justifiable reasons to see some selling, perhaps not this much selling, but to see some selling. But you know, we are looking to position ourselves and look at what's happened over the last couple of days. We've certainly stopped the excessive selling, and now we're looking like we're finding a little bit of support beginning to filter through in these markets. We've had a strong snapback in the dollar CAD, and we look like we found a bit of a floor in gold, and the same really in the euro dollar, although it's looking a little bit bullish as we're recording this video. So we're beginning to see two different momentums play out. If you look at last week to Monday, it was excessive selling. Now we've just spent the last couple of days consolidating and now potentially looking to reverse. So we just want to have a look at some of the data to really see if this particular potential trade in the not too distant future, in fact, we're already getting into this little short-term bullish trade, so we'll see how long that lasts for. But if we bring up Forex Factory, I want to take you back to when this first started, which is effectively, sorry, this is the, let me bring this up instead. Sorry, this is the one. So Thursday, July the 11th, and this is when it all began. And this correlates really with these highs in the S&P 500 and the NASDAQ. So that's when the initial sort of wheels started to come off. But why did they start to come off? Because if you look at July the 11th, you will see that actually inflation came in lower. This is what the Fed were looking for. They're looking for inflation to move back to 2%. And we're beginning to see that in real terms. So you could argue the fact that inflation is rolling lower, that is a reason to potentially look for some upside in these equity markets. And as you can see, we saw some excessive selling. So unemployment claims at that point came in much, much lower than expected. Now they've rallied up to 249. So we have seen a bit of a reversal in this number. But you can see at that point, all looking really quite positive. And it doesn't end there. PPI came in quite positive as well. So it's interesting to see the impact that the consumer sentiment figure actually had, a weakening figure, slightly weakening figure in the face of lowering inflation. So that's not completely where this story ends. We'll move on to the next event. Look at core retail sales. This is only 2-3 weeks ago now. Really positive retail sales, much more positive than this than forecasts were expecting. So a lot of this news is actually really quite relatively positive for the US economy. Now it doesn't stop there. Unemployment on the 18th of July, the unemployment claims, came in considerably above expectations to the tune of 14,000 jobs. So that was a bit of a negative shock. So we did see some selling off around that time, which is very much understandable. Let's move this along. We'll look at the next sort of set of figures. And this is when things began to take a little bit of a turn. Manufacturing coming in much weaker than it was expected, but we did see an upside services PMI number. So services looking really quite strong, whereas the manufacturing PMI numbers coming in weaker than expected. So that is a little bit of an initial trigger. We had, again, more really good news following that event. Advanced GDP numbers. We're expecting 2% growth GDP. This is advanced. This is your first GDP number. And it came in at 2.8. So again, a lot of the data, when you dig deep, looks to be really quite positive. Plus core PCE. This is the Fed's preferred data point coming in line with expectations. And we're certainly sitting around that 2.5% number for core PCE, getting much, much closer to where the Fed want these numbers to be. So then that takes us very nicely to last week's numbers. Consumer confidence is actually coming in better than what was expected. Again, another positive number. The number of jobs available coming in more than expected. Again, another positive number. And then this is when the wheels started to come off a little bit. We had the BOJ announce a 15 basis point rate hike. So we started to see capital come out of the dollar and find a home in the yen. And we saw exceptional volatility around the dismantling of that so-called carry trade. So we've started to see quite a hawkish BOJ. And that was the prelude really to the last Wednesday's ADP numbers, which came in as a bit of a shock, much, much lower than what was expected. So that's a bit of weakness there in the jobs data, followed by pending home sales, which came in much better than expected as we rolled into the FOMC. So Jerome Powell last week kept rates at 5.5%. and alluded to the fact that they'll be looking to cut rates in September. That's pretty much where we're at. So then the market started to take a really significant turn to the downside, and it was supported by the unemployment claims. We're expecting 236,000 unemployment claims, which is up slightly on the previous number, and we saw 249. So that's been the highest number on a weekly unemployment claims number that we've had for a while. Now, there's a few sort of natural type disasters with the hurricane off the coast of America, bringing about potentially a little bit of a spike in unemployment claims. Then ISM manufacturing. This is when we're kind of building on this manufacturing backdrop, and that's coming in lower than expected. So manufacturing is really taking a bit of a beating with higher prices, which is kind of inflationary. So a bit of a really mixed dynamic going into non-farm payroll on Friday, and that was a massive miss with a really sizable unemployment rate, 4.1 jumping up to 4.3. There is this dynamic with the population growth over the last 3 years is somewhere in the region of about 11 million. So could that have an impact on the unemployment rate? We think it probably can. So although it's really bad, it's triggered the SARM rule as well, which just basically suggests that if we get a 50 basis point move in unemployment numbers in a short period of time, that it does suggest we'll be hitting this recession. So this recession backdrop has really taken hold. And then on Monday, which is obviously 2 days ago, we were a bit dubious as to whether, okay, we've had a little bit of negative data, but prior to that, as you can see, we've had a lot of very, very important, significantly positive data around these markets. And that brings us to ISM services. And we weren't expecting this to shift to any great extent, and it didn't, along with final services PMI numbers moving lower. And that brings us up to date, really, as far as the news flow, because there's very little to kind of concern ourselves apart from tomorrow's unemployment claims, which is expected to come in considerably lower. So maybe there's a bit of an adjustment there on the unemployment claims. So apart from 2 or 3 days of certainly news which wasn't particularly positive for markets, and we did get that reaction as well from the BOJ in terms of that hawkish. They decided to pull the trigger on that hawkish angle for these markets. It led to excessive selling. Now, for us, we can't really justify that significant selling. We think it's probably overcooked a little bit, and then all eyes will begin to turn to look at what's going on across those AI stocks. So there's a lot of bearishness in places. There's a lot of incredible bullishness in other areas. And it looks like we're getting a little bit of a bounce off the lows in markets like NVIDIA. And we just name, perhaps, let's have a look at Microsoft as a comparison. That it's looking a little bit, let's say, potentially weaker at this price, but certainly we've had a strong bounce off the lows over the last couple of days. So the hemorrhaging seems to have finished. Now we find ourselves yesterday just moving sideways, and now our bias really is for a little bit of upside in these financial markets. So just to clarify, the S&P 500, we expect it to rally. We expect the NASDAQ to perhaps rally to the 100-period moving average. By default, and we do have, as far as the crude oil is concerned, we've got conflict in the Middle East between Iran and Israel, and will something come of that? We'll have to keep an eye out, because it's likely to impact crude oil prices very significantly. We'd probably expect the gold to continue to rally, and we've already had a bit of a strong snapback in the dollar CAD, so we'll just probably focus our attention on the euro dollar. We had a very significant rally from 107.70 up to over 110, so a sizable move in a very short period of time. We had the pullback, and now it looks like potentially we could start seeing a proper risk-off market condition. A proper risk-on market condition with equities rallying and a weaker dollar. So that's the play. That's what we're going to look to try and see if we can focus our attention on. We wanted to take you back because this is a very worrying time for many traders with their strategies. It's really important to kind of focus on risk management. If you've taken a bit of a significant hit, which some traders have, although it's kind of understandable, it shouldn't really allow it to happen. So as long as you've got your take profit, at which if the market fails to perform, you want to get out of that trade. You don't want to be holding on to trades that are massively offside. That's not really what trading is all about. It should be about the application of a comprehensive risk management approach. And to make things a little bit more complicated, because this is a complicated dynamic, the narratives are a little bit all over the place. So, for example, we've had a strong risk-off market dynamic, which you'd expect with recessionary fears, but we've seen the wheels fall off the dollar at the same time, which you can't really point towards the AI trade, but you could point towards, the fact that the Fed are going to pivot relatively quickly. Bond yields have fallen off a cliff, while we've seen the commodities edge lower. So we've had a few narratives from the risk-off camp and a few narratives from the risk-on camp, and very difficult to pick out which one we should really stick with. Okay then, so listen, thanks very much for joining us. If you do have any questions about anything covered in this webinar, do feel free to email us at support@thelivetraderoom.com. We'd be happy to get back to you as soon as we can. So all that's left for me to do now is to thank you for joining us. Hopefully you've just found a little bit of useful information on this, that we are certainly, although the selling was incredibly excessive, we think there is broad positivity still. We don't think the fundamentals have severely impacted the underlying fundamentals. Those numbers could correct themselves relatively swiftly, and then we'll all be scratching our heads to see what was all the fuss about. So at the same time, we want to keep our options open just in case these markets do start to tank off a bit of bad news. So we always want to be mindful and be able to just keep both options open, not get too entrenched on a buy trade or a sell trade. But if the markets bounce, we look to run with it, and if they start to roll over aggressively, we look for some selling opportunities as well. Okay, so look, I hope that makes sense. It's not particularly clear, but hopefully we've given you a bit of context really, and showing you really what we're looking to do. So if you are interested in learning how to trade, you can access one of our discounted live trading and education bonds on our website. It just starts from just $59 per calendar month. We're live broadcasting every day, somewhere in the region of about 5 hours every day. So you're very welcome to join us, see what we trade, see how we benefit from whatever opportunities come our way, with a strong approach to risk management. So where a lot of people suffered losses over the last month, we've actually seen a gain. Not quite as much as we would have liked, but we haven't seen any losses, which is good. Okay, so on that note, thanks very much for joining us as always. For more information, just go to thelivetraderoom.com, and we shall speak to you next time. Bye for now.